Greetings, knowledge seekers, and welcome back to BookMint, the podcast that distills the essence of groundbreaking literature into digestible, engaging insights. Today, we're not just reading a book, we're witnessing a revolution unfold, a digital tremor that continues to reshape the very foundations of our global financial and economic systems. We are embarking on an extensive journey through the age of cryptocurrency, how Bitcoin and digital money are challenging the global economic order. A seminal work by the brilliant minds of Paul Vigna and Michael J. Published at a pivotal moment, this book provided an early, yet remarkably prescient, glimpse into the transformative power of Bitcoin and the burgeoning world of digital currencies. It's a narrative of innovation, disruption, controversy, and profound change that resonates even more powerfully today than when it first hit the shelves. If you're ready to understand the forces behind the digital money revolution, how it threatens established powers, and what it means for your financial future, then prepare to be enlightened. Before we delve into this expansive exploration, I kindly ask you to take a moment to like this video. Share it with your networks, because everyone deserves to understand this crucial shift. And if you haven't already, please subscribe to BookMint. Your engagement fuels our mission to bring you more in-depth summaries of the books that truly matter. Now, let's unravel the intricate tapestry of the age of cryptocurrency. Chapter 1. The New Money. A digital phoenix rises from the ashes of distrust. Paul Vigna and Michael J. commenced the age of cryptocurrency by immediately transporting us to a period of profound global financial instability, the aftermath of the 2008 financial crisis. This backdrop is not merely chronological, but fundamentally thematic. For it was from the ashes of widespread distrust in traditional banks, government oversight, and centralized financial institutions that Bitcoin, the enigmatic new money, emerged. The authors meticulously detail Bitcoin's mysterious genesis in 2009, attributed to the pseudonymous Satoshi Nakamoto. This anonymity, they argue, is not an incidental detail, but a core tenet, reinforcing Bitcoin's independence from any single authority. The chapter serves as a comprehensive introduction to Bitcoin's revolutionary architecture. At its heart lies the concept of decentralization. Unlike the fiat currencies we use daily, which are issued and controlled by central banks, Bitcoin operates on a peer-to-peer network without any single point of control. This fundamental departure from traditional monetary systems is meticulously unpacked. Vigna and explain how Bitcoin's supply is algorithmically capped at 21 million units, a stark contrast to the potentially infinite quantitative easing capabilities of central banks. This scarcity, they contend, is foundational to Bitcoin's hard money philosophy, mirroring historical precedents like gold. A significant portion of this chapter is dedicated to elucidating the blockchain, Bitcoin's underlying distributed public ledger. The authors describe it as an unchangeable, transparent record of every Bitcoin transaction, verified and maintained by a global network of participants rather than a single bank. This cryptographic security and transparency are presented as antidotes to the opaqueness and fallibility of conventional financial ledgers. They delve into how transactions are broadcast, validated by miners, and bundled into blocks that are then added to the ever-growing chain.
The immutability of these records, once inscribed, is highlighted as a key innovation, fostering trust in a trustless environment. Vigna and Casey introduce us to Bitcoin's earliest adopters, a motley crew of libertarians, tech enthusiasts, cypherpunks, and anarchists. These individuals, disillusioned by government surveillance and the centralized control over money, saw Bitcoin not just as an alternative payment system, but as a potent political tool for financial sovereignty and individual freedom. The authors acknowledge the nascent and often esoteric nature of Bitcoin in its early days, frequently misunderstood or dismissed by the mainstream. They touch upon the initial challenges, the steep learning curve for users, the nascent infrastructure, and the prevalent skepticism from established financial players and the general public. This chapter effectively sets the stage, framing Bitcoin as more than just a digital currency. It is presented as a philosophical and technological challenge to the global economic order. It establishes the core pillars of Bitcoin: decentralization, scarcity, transparency, and censorship resistance that will become the battlegrounds for its future adoption, regulation, and integration into the fabric of society. The new money, as the authors portray it, is a digital phoenix, rising not just as an innovation, but as a direct response to a crisis of faith in the old monetary gods.
Chapter 2: The Original Sin, Shadows in the Early Dawn. In The Original Sin, Vigna and Casey confront head-on the earliest and most persistent criticisms that plagued Bitcoin, significantly impeding its path toward mainstream acceptance. Its original sin, they refer to, is Bitcoin's early and prominent role as the de facto currency for the dark web marketplace, Silk Road. This chapter is a crucial historical account, illustrating how the perceived anonymity and borderless nature of Bitcoin made it an attractive medium for transactions involving illegal drugs, weapons, and other contraband. The authors provide a detailed narrative of Silk Road, conceived and operated by Ross Ulbricht under the pseudonym Dread Pirate Roberts. They describe how this online marketplace capitalized on Bitcoin to facilitate transactions, creating a seemingly impenetrable veil of privacy for both buyers and sellers. This period indelibly linked Bitcoin in the public consciousness with criminal enterprise, fostering a narrative that it was primarily a tool for money laundering and other nefarious deeds. Vigna and Casey meticulously trace the rise of Silk Road, its operational model, and the eventual dramatic takedown by law enforcement agencies, culminating in Ulbricht's arrest and conviction. The legal and ethical arguments surrounding Bitcoin's culpability are explored. Proponents often argued that traditional cash has always been the preferred medium for illicit activities, and Bitcoin's public ledger, in fact, offers a degree of traceability that cash does not. However, the authors acknowledge that the novelty of a digital, decentralized, and pseudo-anonymous currency presented unprecedented challenges for law enforcement and regulators. Beyond the specter of Silk Road, the chapter expands on other early sins and vulnerabilities that tarnished Bitcoin's reputation. Foremost among these was the catastrophic collapse of Mt. Gox. Once the largest Bitcoin exchange in the world, Mt. Gox handled a staggering percentage of global Bitcoin trades before its spectacular downfall in 2014. Resulting in the loss of hundreds of thousands of Bitcoins and hundreds of millions of dollars for its users. Vigna and Casey vividly recount the chaos and despair surrounding the Mt. Gox debacle, attributing it to a combination of lax security, mismanagement, and technical vulnerabilities. This incident, along with numerous smaller hacks and scams, exposed the inherent risks of a nascent, unregulated ecosystem, leaving many early investors financially devastated and public perception severely damaged. The authors also touch upon the general lack of consumer protection and the absence of regulatory frameworks in the early days. Without governmental oversight, insurance, or established legal recourse, individuals bore the full brunt of these losses, further cementing the view that Bitcoin was a wild, dangerous frontier. The original sin is not just a recounting of past mistakes. It's a critical examination of the growing pains of a revolutionary technology. It illustrates how Bitcoin, despite its lofty ideals of decentralization and freedom, was simultaneously grappling with its own internal fragilities and external misuses, which would necessitate a difficult, ongoing evolution toward greater security, legitimacy, and regulatory compliance. This chapter serves as a stark reminder that innovation, especially disruptive innovation, rarely comes with its moral and practical compromises, casting long shadows even as it promises a brighter future.
Chapter 3: The Promise of the Blockchain Beyond the Coin. Chapter 3 marks a pivotal turn in the age of cryptocurrency, shifting the spotlight from Bitcoin, the currency, to its foundational technology, the blockchain. Vigna and Casey assert that while Bitcoin captured initial attention, the true revolutionary potential lies in the underlying distributed ledger technology, which they believe will impact far more than just financial transactions. This chapter is a deep dive into what makes the blockchain so profoundly innovative, extending its promise far beyond the realm of digital money. The authors begin by providing a clear and comprehensive definition of the blockchain. They characterize it as a distributed, immutable, and transparent ledger. Each of these attributes is meticulously explained. Distributed. Unlike traditional databases controlled by a single entity, the blockchain is maintained by a network of computers, nodes, globally. This means no single point of failure, making it highly resilient to censorship and manipulation. Immutable. Once a piece of data, a transaction is recorded on the blockchain and validated. It cannot be altered or deleted. This permanence ensures integrity and trust, eliminating the need for intermediaries to verify records. Transparent. While identities can be pseudonymous, all transactions and data recorded on the public blockchain are visible to anyone on the network. This radical transparency fosters accountability and reduces the potential for hidden activities. Vigna and Casey then elucidate the core mechanics of how the blockchain functions. They describe the cryptographic hashing that links blocks together, forming an unbroken chain of records. They detail the consensus mechanisms, specifically Bitcoin's proof of work, where miners compete to solve complex computational puzzles to validate transactions and add new blocks. This energy-intensive process, they explain, is what secures the network against fraudulent entries. The authors emphasize that the brilliance of the blockchain lies in its ability to generate trust in a trustless environment. By cryptographically securing records and distributing their maintenance across a network, it eliminates the need for a central authority to vouch for the veracity of information. The heart of this chapter, however, lies in its exploration of the myriad potential applications of blockchain technology beyond Bitcoin. Vigna and Casey ignite the reader's imagination by envisioning a future where blockchain could fundamentally transform various industries. Supply chain management. Imagine tracking every step of a product's journey, from raw materials to the consumer, on an immutable ledger. This could guarantee authenticity, prevent counterfeiting, and provide unparalleled transparency in logistics. Digital identity. Individuals could regain sovereign control over their personal data, storing and sharing it securely on a blockchain, rather than relying on centralized entities prone to data breaches. Property and asset registries. Land titles, intellectual property, and other valuable assets could be recorded on a blockchain, preventing fraud, streamlining transfers, and reducing disputes. Voting systems. Blockchain could offer a secure, transparent, and verifiable method for conducting elections, addressing concerns about electoral integrity. Healthcare records. Patient data could be securely stored and selectively shared, empowering individuals while ensuring privacy. The chapter also introduces the nascent but revolutionary concept of smart contracts. These are self-executing contracts where the terms of an agreement are directly written into lines of code on the blockchain. Once the predetermined conditions are met, the contract automatically executes, eliminating the need for lawyers, notaries, or other intermediaries. This innovation, they argue, has the potential to automate agreements, reduce costs, and accelerate transactions across countless sectors. Vigna and Casey acknowledge that many of these applications are still theoretical or in early development, but they passionately convey the immense potential. The promise of the blockchain effectively elevates the conversation from a niche digital currency to a foundational technology poised to reshape global commerce, governance, and trust itself, setting the stage for an era of unprecedented decentralization.
Chapter 4. The Miners and the Merchants, the Two Pillars of Utility. In Chapter 4, Vigna and Casey illuminate the twin forces crucial for Bitcoin's functionality and real-world utility: the miners who secure the network and the merchants who facilitate its adoption as a medium of exchange. This chapter offers a practical and granular look at the operational aspects of the Bitcoin ecosystem, moving beyond abstract concepts to the tangible efforts of participants. The authors begin by demystifying Bitcoin mining. They explain that miners are not simply creating money, but are performing a vital service, expending computational power to verify and validate Bitcoin transactions, bundling them into new blocks, and adding these blocks to the blockchain. This process, known as proof of work, involves solving complex cryptographic puzzles. The first miner to solve the puzzle earns the right to add the next block and is rewarded with a set amount of newly minted bitcoins, the block reward, plus any transaction fees associated with the verified transactions. Vigna and Casey detail the evolution of mining, from early hobbyists using personal computers to the emergence of specialized hardware, ASICs, and large-scale mining farms. They discuss the increasing difficulty of mining, the competitive landscape, and the significant energy consumption associated with the process, which even in the book's publication era was becoming a notable point of contention and discussion. They underscore that mining is a critical incentive mechanism, ensuring the security and integrity of the decentralized network. Moving to the demand side, the chapter pivots to the crucial role of merchants and the challenges of integrating Bitcoin into everyday commerce. The authors recount the initial excitement among some businesses, particularly online retailers and tech-forward enterprises, who saw Bitcoin as a potentially revolutionary payment method. The perceived advantages for merchants included lower transaction fees. Compared to credit card processing fees, typically 2 to 3%, Bitcoin transactions often had significantly lower costs. No chargebacks. The irreversible nature of Bitcoin transactions meant merchants were protected from fraudulent chargebacks, a common problem with credit card payments. Global reach. Bitcoin offered a seamless way to accept payments from customers anywhere in the world, without currency conversion issues or international banking delays. Attracting early adopters. Accepting Bitcoin could position a business as innovative and attract a niche but growing customer base. However, Vigna and Casey are careful to highlight the substantial hurdles that prevented widespread merchant adoption. The most significant challenge was volatility. The wild price swings of Bitcoin meant that a payment received today could be worth significantly less tomorrow, creating immense risk for businesses. Other barriers included complexity. Setting up and managing Bitcoin payment systems required technical expertise and was more cumbersome than existing fiat payment rails. Lack of consumer demand. For a long time, very few customers actually wanted to spend their Bitcoins, preferring to hold them as an investment. HODL culture. Regulatory uncertainty. Businesses were wary of the evolving legal and tax implications of accepting cryptocurrency. The authors highlight pioneering efforts by companies like Overstock.com, which became one of the first major online retailers to accept Bitcoin directly, demonstrating the feasibility of integration. They also introduce the critical role of payment processors like BitPay and Coinbase, which acted as intermediaries to simplify Bitcoin acceptance for merchants. These services would instantly convert Bitcoin payments into fiat currency, insulating businesses from volatility risk and handling the technical complexities, effectively bridging the gap between the crypto world and the traditional economy. The miners and the merchants effectively illustrates the practical, ground-level efforts required to build and sustain the Bitcoin ecosystem. It underscores that for Bitcoin to truly become money, it needed both the robust, secure infrastructure provided by miners and the widespread utility facilitated by merchants. The chapter reveals the inherent tension between the decentralized technological ideal of Bitcoin and the pragmatic, often compromise-laden realities of integrating it into the existing global commercial order.
Chapter 5: The Regulators and the Revolution, a Dance of Control and Chaos. Chapter 5, The Regulators and the Revolution, plunges into the inevitable and often contentious clash between the burgeoning, decentralized world of cryptocurrency and the established, centralized authority of national governments and financial regulatory bodies. Vigna and Casey depict a global landscape marked by confusion, apprehension, and often reactive responses from regulators grappling with a technology that defied traditional classifications and existing legal frameworks. The core dilemma for governments was immense: how to manage the risks associated with an anonymous, borderless, and rapidly evolving digital asset, protect citizens, prevent illicit activities, and maintain monetary sovereignty, all without stifling potentially transformative innovation. The authors meticulously detail the varied and often conflicting approaches taken by different jurisdictions around the world. They illustrate a spectrum of responses. Hostility and bans. Some countries initially adopted an outright hostile stance, issuing stern warnings against Bitcoin, attempting to ban its use, or severely restricting related activities. These nations often viewed cryptocurrencies as a direct threat to their monetary control, a vehicle for capital flight, or a destabilizing force for their economies. Cautious observation. Many governments initially opted for a wait-and-see approach, unsure how to categorize or regulate this novel phenomenon. This period was characterized by public statements of caution, formation of task forces, and ongoing internal debates. Embrace and experimentation. A few forward-thinking jurisdictions, often smaller nations or regions with a strong tech focus, began to explore the potential benefits of digital currencies and blockchain, seeking to position themselves as innovation hubs. Vigna and Casey delve into the primary concerns that fueled regulatory apprehension: money laundering, AML, and counter-terrorist financing, CTF. The perceived anonymity of cryptocurrency transactions was a major red flag for law enforcement and financial intelligence units globally. Regulators feared that Bitcoin could become a powerful tool for obscuring illicit financial flows. Consumer protection. The extreme price volatility, the numerous scams, hacks, and exchange failures like MT-Gox left many investors financially ruined. Regulators felt a duty to protect consumers from these inherent risks in an unregulated market. Taxation. Governments struggled to determine how to effectively tax cryptocurrency holdings, capital gains, and transactions, leading to uncertainty for users and compliance challenges for tax authorities. Monetary policy and financial stability. Central banks worried about the potential impact of widely adopted cryptocurrencies on their ability to conduct monetary policy, control inflation, and maintain the stability of their national financial systems. Systemic risk. While Bitcoin was initially too small to pose a systemic threat, regulators pondered its potential implications if it grew to rival traditional financial assets in scale. The authors highlight pivotal early regulatory actions, such as the U.S. Treasury's Financial Crimes Enforcement Network, FinCEN, classifying Bitcoin exchanges as money services businesses, MSBs. This designation forced exchanges to implement anti-money laundering, AML, and Know Your Customer, KYC, compliance measures, effectively bringing them under a degree of traditional financial regulation. They also touch on the early scrutiny from the Securities and Exchange Commission, SEC, regarding the potential classification of certain digital assets as securities. The Regulators and the Revolution vividly portrays the inherent tension between technological innovation driven by decentralized ideals and the imperative of state control and protection. The chapter concludes that a complete suppression of cryptocurrency would be exceedingly difficult due to its decentralized nature, yet a completely unregulated free-for-all would be catastrophic. The future, the authors suggest, lies in a difficult and ongoing negotiation, a delicate dance between control and chaos, as regulators strive to find an appropriate balance that fosters innovation while mitigating unacceptable risks. This chapter underscores that the long-term trajectory of cryptocurrency is inextricably linked to how this complex regulatory landscape evolves globally.
Chapter 6. The Innovation Equation. Beyond Bitcoin's Shadow. In The Innovation Equation, Vigna and Casey broaden their focus, demonstrating that Bitcoin, while revolutionary, was merely the spark that ignited a far larger technological and economic movement. This chapter delves into the vast ecosystem of innovation that quickly emerged in Bitcoin's wake, extending the principles of decentralization and distributed ledgers into an astonishing array of new applications and alternative cryptocurrencies. It underscores the author's thesis that the underlying blockchain technology is perhaps even more transformative than Bitcoin itself. The authors meticulously explore several key avenues of this burgeoning innovation: the rise of altcoins and competing cryptocurrencies. Bitcoin's open-source nature allowed developers to fork its code or create entirely new cryptocurrencies, altcoins, with different design parameters. Vigna and Casey detail the early proliferation of these altcoins, each attempting to address perceived shortcomings of Bitcoin or to cater to specific use cases. This included faster transaction speeds, altcoins designed for quicker block times and higher transaction throughput,
different consensus mechanisms, experimentation beyond proof of work to address energy consumption or centralization concerns, enhanced privacy features, cryptocurrencies focusing on stronger anonymity for transactions, specialized functions, altcoins built for particular niches, from digital content creation to gaming. This competitive environment, the authors argue, fostered rapid experimentation and pushed the boundaries of what was technologically possible in the crypto space. Smart contracts and decentralized applications, dApps. A significant portion of this chapter is dedicated to the revolutionary concept of smart contracts. Vigna and Casey elaborate on these self-executing agreements, where the terms are directly embedded into code on the blockchain. They explain how these contracts, once conditions are met, automatically execute without the need for intermediaries like lawyers or banks. This innovation promises to automate agreements, reduce legal costs, and increase efficiency across countless industries. The authors touch upon the emergence of platforms like Ethereum, which was still in its conceptual or very early stages during the book's writing, but would soon become dominant, specifically designed as general-purpose blockchains capable of hosting a vast ecosystem of decentralized applications, dApps. They envision dApps as transparent, censorship-resistant alternatives to traditional apps, potentially disrupting finance, DeFi, insurance, gaming, social media, and more. Tokenization of assets. The chapter introduces the powerful idea of tokenizing real-world assets. This involves representing tangible or intangible assets, such as real estate, fine art, commodities, or even company shares as digital tokens on a blockchain. This innovation has the potential to enable fractional ownership, making illiquid assets accessible to a broader range of investors. Increase liquidity, facilitating easier and faster transfer of ownership. Enhance transparency and auditability, providing an immutable record of ownership. Democratize investment, opening up new avenues for capital formation and access to markets. New business models and governance structures. Vigna and Casey explore how blockchain technology facilitates entirely new organizational and economic models. They discuss the emergence of peer-to-peer lending platforms, decentralized exchanges that remove intermediaries, and new forms of crowdfunding, like ICOs, which would explode later. They also touch upon the nascent concept of decentralized autonomous organizations, DAOs, where organizational rules are encoded in a transparent blockchain and decisions are made by token holders, challenging traditional corporate governance. The innovation equation paints a vibrant picture of a burgeoning technological frontier. The authors acknowledge that this era of rapid innovation was characterized by both brilliant successes and spectacular failures, a necessary process of trial and error. They emphasize the role of a passionate global community of developers, entrepreneurs, and visionaries driving this explosion of creativity. This chapter effectively demonstrates that Bitcoin was merely the first domino, setting off a chain reaction of disruptive ideas and applications, all leveraging the fundamental principles of decentralization and cryptographic security to redefine how value is exchanged, information is managed, and trust is established in the digital age. It underscores that the age of cryptocurrency is ultimately an age of innovation, constantly pushing the boundaries of what's possible.
Chapter 7. The Investment Roller Coaster. Fortunes Won and Lost. Chapter 7 of The Age of Cryptocurrency provides a gripping account of the nascent and often tumultuous world of cryptocurrency investment, aptly characterizing it as a true roller coaster ride.
Vigna and Casey meticulously chronicle the extreme volatility that defined Bitcoin's early price movements, from its near-zero value in 2009 to its first significant price spikes and subsequent, often brutal, crashes. This chapter is a crucial historical record of how Bitcoin swiftly became a magnet for both seasoned investors and eager amateur speculators, all drawn by the intoxicating allure of unprecedented returns and the compelling narrative of a revolutionary technology. The authors delve into the complex interplay of factors that contributed to this inherent and dramatic volatility. Limited supply versus surging demand. Bitcoin's fixed supply cap, combined with growing awareness and increasingly fervent speculation, created intense upward pressure on prices during bullish sentiment. Speculative nature. Much of the early investment was driven less by a stable assessment of intrinsic value or widespread utility, and more by pure speculation, the belief that prices would continue to rise due to future adoption and mainstream acceptance. This created a self-fulfilling prophecy during bull runs, often followed by sharp corrections when sentiment shifted. Shallow markets and low liquidity. In its early years, the crypto market was relatively small and illiquid. This meant that even moderately sized buy or sell orders could significantly impact prices, leading to exaggerated movements compared to mature financial markets. Impact of news and events. The authors highlight how major news stories, whether positive, example a new merchant accepting Bitcoin, or negative, example a regulatory crackdown, an exchange hack like Mt. Gox, or controversial statements from influential figures, could trigger instantaneous and dramatic price swings, often exacerbated by the 24/7 nature of crypto trading. Herd mentality and psychological factors. The fear of missing out, FOMO, frequently led to irrational buying sprees during rallies, while fear, uncertainty, and doubt, FUD, could trigger panic selling during downturns. Vigna and Casey explore this powerful psychological dynamic that amplified market movements. Lack of valuation frameworks. Unlike traditional assets with established metrics, example P/E ratios for stocks, cash flow for businesses, valuing Bitcoin in its early stages was challenging. This absence of clear valuation models contributed to speculative fervor and made it difficult for investors to determine fair value. Vigna and Casey discuss the emergence of various methods for engaging with this new asset class. This included direct purchases on nascent exchanges, peer-to-peer trading, and eventually the development of more sophisticated financial products as the market matured. This chapter explores the motivations and psychology of early crypto investors, many of whom were drawn not only by profit potential, but also by the anti-establishment, libertarian ethos of Bitcoin, viewing it as a hedge against traditional financial markets and government control. However, they also provide a cautionary perspective, recounting stories of immense wealth accumulation alongside devastating losses for those caught on the wrong side of market movements. The investment roller coaster provides an essential historical lens through which to understand the market dynamics that have continually shaped the perception, adoption, and integration of cryptocurrencies into the global financial consciousness. It vividly illustrates the thrilling, yet perilous, ride that early participants endured, solidifying the idea of crypto as a high-risk, high-reward asset class. This chapter reinforces that for all its technological promise, the immediate experience of cryptocurrency for many has been dominated by its often wild market fluctuations, impacting both individual fortunes and the broader perception of its legitimacy and stability.
Chapter 8: The Remittance Revolution, Empowering the Unbanked. In Chapter 8, The Remittance Revolution, Vigna and Casey shift their focus to one of the most compelling and socially impactful use cases for cryptocurrency: its potential to utterly transform cross-border remittances. This chapter brings a humanitarian dimension to the narrative, highlighting how digital money could directly benefit millions of people, particularly those in developing countries, by addressing a long-standing and often exploitative facet of the global financial system. The authors begin by meticulously dissecting the existing traditional remittance industry. They expose the high costs and inherent inefficiencies of conventional services like Western Union and MoneyGram. They explain that migrant workers who send billions of dollars annually back to their families in their home countries are often subjected to exorbitant fees, unfavorable exchange rates, and lengthy transfer times. For many, these fees represent a significant percentage of their hard-earned income, while delays can have severe consequences for families reliant on timely financial support for essentials like food, shelter, and medical care. The traditional system, they argue, is ripe for disruption because it is built on layers of intermediaries, each taking a cut and adding to the processing time. Vigna and Casey then present Bitcoin and other cryptocurrencies as a powerful and elegant solution to these deeply entrenched problems. They illustrate how digital money offers distinct advantages: significantly lower fees. Bitcoin transactions, particularly in the book's early time frame, typically incurred fees that were a fraction of those charged by traditional remittance services. This means more money directly reaches the intended recipient, maximizing the impact of the sender's efforts. Faster transfer times. Cryptocurrencies can be sent across borders in minutes or even seconds, bypassing the often multi-day delays of conventional banking systems that rely on complex clearing processes and multiple intermediaries. This speed can be life-changing for families in urgent need of funds. Financial inclusion for the unbanked? One of the most profound impacts highlighted is the potential for financial inclusion. For the unbanked or underbanked populations globally, billions of people lacking access to traditional bank accounts, cryptocurrencies offers a gateway to participate in the global financial system, using just a smartphone and an internet connection. This empowers individuals who were previously excluded by geographic location, lack of identification, or high minimum balance requirements. Borderlessness and accessibility. Cryptocurrencies operate globally, transcending national borders and reducing the friction associated with international transfers. Senders can send money from almost anywhere to recipients almost anywhere, provided they have access to the network. Transparency with pseudonymity. While maintaining a degree of user pseudonymity, the public ledger of the blockchain can offer transparency regarding the movement of funds, potentially reducing corruption in aid or large-scale transfers. The authors showcase emerging companies and initiatives that were actively leveraging Bitcoin to create new remittance corridors, particularly between developed nations and regions like the Philippines, Latin America, and Africa. They describe various models, from direct crypto-to-crypto transfers to hybrid systems where senders buy crypto, transmit it, and recipients cash out into local fiat currency through a network of local agents or exchanges. This last-mile conversion problem, while a challenge, was being actively addressed. However, Vigna and Casey are careful to also address the practical challenges that still needed to be overcome. Volatility risks. While less of an issue for instant transfers, the fluctuating price of Bitcoin could still pose a risk if funds were held in crypto for any significant period before conversion to local currency. Liquidity and infrastructure. The availability of reliable local exchanges and cash-out points was crucial and varied significantly across different regions. Regulatory obstacles, anti-money laundering and know-your-customer regulations posed significant hurdles for remittance providers operating in multiple jurisdictions, requiring careful compliance strategies. The remittance revolution stands out as a powerful demonstration of cryptocurrency's capacity for tangible, positive societal impact. It positions digital money not merely a speculative asset or a technical curiosity, but as a practical tool for empowering individuals, fostering financial equity, and disrupting an established industry that has long profited from the necessity of vulnerable populations. This chapter profoundly illustrates how Bitcoin and its progeny are challenging the global economic order by offering a more efficient, accessible, and fair alternative for fundamental financial services.
Chapter 9: The Dark Side of the Blockchain, the Shadow of Innovation. In The Dark Side of the Blockchain, Vigna and Casey undertake a critical, balanced examination of the inherent risks, ethical dilemmas, and negative consequences associated with cryptocurrency and blockchain technology. While celebrating the innovation, this chapter serves as a crucial counterpoint, moving beyond the initial original sin to explore the more enduring challenges posed by a decentralized and often pseudo-anonymous financial system. It acknowledges that even the most revolutionary tools can be wielded for nefarious purposes or carry unintended societal costs. The authors delve into several pervasive, dark aspects. Continued illicit activities. Despite increasing regulatory scrutiny and improved tracing capabilities, cryptocurrencies remain attractive to criminal elements. Vigna and Casey elaborate on how they are used for ransomware attacks, where criminals demand crypto payments to unlock encrypted data; terrorist financing. Though often smaller in scale than traditional methods, crypto offers a difficult-to-trace avenue for funding; drug trafficking and other contraband. The dark web continues to evolve, finding new ways to utilize crypto. Online fraud and scams. The pseudo-anonymity of Bitcoin, where transactions are public but identities behind wallet addresses are not immediately obvious, still makes tracing funds challenging for law enforcement, particularly when sophisticated obfuscation techniques like mixers or tumblers are employed to blend coins and obscure their origin. Scams, fraud, and investor protection. The unregulated and often complex nature of the crypto market creates a fertile ground for scams. The authors discuss various types of fraud prevalent in the early days. Ponzi schemes, where early investors are paid with funds from later investors. For example, infamous schemes like BitConnect, which gained notoriety after the book's publication, but the underlying patterns were visible. Phishing attacks and wallet thefts. Exploiting user naivete or security vulnerabilities to steal private keys or cryptocurrency holdings. Pump and dump schemes. Artificially inflating the price of a lesser-known cryptocurrency through misleading statements, then selling off holdings for profit. Fake initial coin offerings or ICOs. Fraudulent projects masquerading as legitimate fundraising opportunities. The irreversible nature of cryptocurrency transactions means that once funds are sent to a scammer, recovery is virtually impossible, leaving victims with little recourse. Money laundering. The chapter provides a deeper analysis of how cryptocurrencies facilitate money laundering. They explain how techniques like chain hopping, or converting between different cryptocurrencies, and using offshore exchanges can complicate efforts to follow the money trail, even with blockchain's inherent transparency. Technological vulnerabilities and operational risks. Beyond deliberate malice, the authors address the inherent technical fragility of a nascent ecosystem. This includes software bugs, flaws in blockchain protocols or smart contracts that can be exploited, exchange hacks. Centralized exchanges remain attractive targets for cybercriminals, leading to massive losses for users. Key management failures.
Users losing their private keys means permanent loss of funds, a significant barrier to mainstream adoption. The 51% attack threat. The theoretical risk that a single entity could gain control of more than half of a blockchain's mining power, potentially allowing them to manipulate transaction history, though highly impractical for large blockchains like Bitcoin. Environmental impact of mining. While touched upon briefly earlier, this chapter provides a more direct critique of the environmental cost of Bitcoin's proof-of-work consensus mechanism. The authors highlight the immense electricity consumption required to power mining operations, raising concerns about its carbon footprint and long-term sustainability as the network grows. Centralization risks within decentralized systems. Ironically, even systems designed for decentralization can exhibit centralizing tendencies. This includes the concentration of mining power in a few large pools, the dominance of a handful of major exchanges, and the disproportionate influence of early investors, or whales. These concentrations, the authors argue, can underline the democratic and censorship-resistant ideals upon which cryptocurrency was founded. The dark side of the blockchain serves as a crucial, sobering counterpoint to the optimistic narrative of innovation. It emphasizes that revolutionary technologies are inherently dual-edged. While offering unprecedented opportunities for freedom and efficiency, they also open new avenues for exploitation, abuse, and unintended consequences. The authors conclude that ignoring these darker aspects is perilous. Instead, robust solutions, thoughtful regulation, enhanced security measures, and extensive public education are essential to mitigate the risks and harness the transformative power of blockchain responsibly. This chapter reinforces that the evolution of cryptocurrency is not just a technical challenge, but a profound societal and ethical one.
Chapter 10. The Geopolitics of Crypto, a New World Order. Chapter 10. The Geopolitics of Crypto significantly elevates the scope of the age of cryptocurrency, moving beyond individual transactions and market dynamics to examine the profound impact of Bitcoin and other digital currencies on international relations, national security, and the global balance of power. Vigna and Casey argue that cryptocurrency is not merely an economic or technological phenomenon, but a powerful new tool with far-reaching implications for diplomacy, national security, and the very structure of the global financial system. The authors explore several critical geopolitical dimensions. Challenging sanctions and capital controls. One of the most immediate and impactful geopolitical implications is cryptocurrency's potential to circumvent international sanctions and national capital controls. For countries facing severe economic sanctions, such as Iran, North Korea, and later Venezuela, Bitcoin offers a pathway to conduct international trade and access global markets outside the traditional US dollar-dominated financial system. This capability directly challenges the effectiveness of sanctions as a foreign policy instrument, potentially undermining the leverage of powerful nations like the United States. Similarly, individuals in countries with oppressive capital controls can use crypto to move wealth across borders, subverting government efforts to manage currency flows and prevent capital flight. Monetary sovereignty and national control. Cryptocurrencies pose a direct, existential challenge to the monetary sovereignty of nation-states. If a widely adopted, decentralized digital currency gains significant traction within a country, it could erode the power of central banks to control their national currencies, conduct effective monetary policy, such as setting interest rates, managing inflation, and maintain economic stability. This fundamental threat to state control over its economy is a major reason why many governments view unregulated cryptocurrencies with extreme suspicion. Currency competition and digital hegemony. The chapter speculates on a future where various digital currencies could compete on a global scale, much like fiat currencies do today, but with potentially different characteristics and advantages.
This could lead to a significant shift in global financial hegemony, potentially away from the US dollar's long-standing dominance, if a more efficient, secure, or widely accepted digital currency emerges as a preferred medium for international trade and reserves. The authors implicitly raise questions about the implications for geopolitical influence if financial power is diffused. Cyber warfare, espionage, and national security. Vigna and Casey discuss the national security ramifications, particularly in the context of cyber warfare and the funding of state and non-state adversarial groups. While cryptocurrency offers tools for dissidents within authoritarian regimes, allowing them to receive funds or organize outside state surveillance, it also presents avenues for state-sponsored hacking groups, terrorist organizations, or rogue actors to fund their operations, pay ransoms, or move illicit wealth with greater difficulty for traditional intelligence agencies to trace. The race for blockchain supremacy and CBDCs. Nations are beginning to recognize the strategic importance of blockchain technology itself, beyond just cryptocurrencies. The chapter touches upon the nascent stages of a global race to develop national blockchain strategies, invest in distributed ledger technology research, and potentially even issue central bank digital currencies, or CBDCs. This drive is motivated by a desire to maintain financial control, enhance payment efficiency, and harness the technological benefits of blockchain within a regulated framework, as a direct response to the challenge posed by decentralized cryptocurrencies. Financial inclusion as a geopolitical tool. On a more positive note, the authors acknowledge that cryptocurrency can empower individuals and foster economic development in developing countries by providing access to global financial services. This could indirectly reshape geopolitical power balances by creating new avenues for wealth creation and economic autonomy in regions historically marginalized by the traditional financial system. The Geopolitics of Crypto concludes that the rise of digital money is forcing governments, international organizations, and policymakers to fundamentally rethink their assumptions about money, power, and control in an increasingly interconnected and digital world. It paints a picture of a future where financial warfare, economic influence, and even national stability could be profoundly shaped by the evolving landscape of decentralized digital assets, leading to both intensified competition and new forms of cooperation on the global stage. This chapter underscores that the age of cryptocurrency is not just an economic revolution, but a geopolitical one, redefining the very instruments of state power.
Chapter 11. The Future is Decentralized, a New Paradigm of Trust. In the concluding chapter, The Future is Decentralized, Paul Vigna and Michael J. Casey synthesize their intricate exploration of cryptocurrency and blockchain technology into a compelling, forward-looking vision. They assert that the age of cryptocurrency is far more than just a story of digital money. It represents a foundational paradigm shift in how humanity organizes, transacts, and establishes trust in an increasingly digital and interconnected world. The authors reiterate their core thesis that decentralization, powered by the ingenious architecture of the blockchain, is poised to profoundly disrupt and redefine countless facets of our lives, fundamentally challenging the centralized intermediaries that have governed our societies and economies for centuries. Vigna and Casey articulate an optimistic yet sober vision of a decentralized future, detailing its potential impact across various domains. Radical financial inclusion. The authors envision a world where the billions of unbanked and underbanked individuals globally finally gain access to robust, affordable, and accessible financial services. Remittances will become cheaper and faster, empowering migrant workers and their families. Individuals will exercise greater autonomy over their economic lives, liberated from the often predatory practices of traditional financial institutions and the instability of some national currencies. This fundamentally reshapes economic opportunity and equality on a global scale.
transparent and accountable governance. Blockchain technology holds the promise of revolutionizing public services, enhancing the integrity of voting systems, and streamlining record-keeping for governments. By creating immutable and transparent ledgers, it could make governments more accountable, reduce corruption, and foster greater public trust. Furthermore, the concept of self-sovereign identity, SSI, powered by blockchain, could empower citizens with complete control over their personal data, moving away from centralized databases prone to breaches and surveillance. This represents a return to greater individual agency in the digital realm. A more resilient global infrastructure. A distributed financial and informational infrastructure, by its very nature, is more resilient to systemic shocks, single points of failure, and the arbitrary whims of centralized authorities. This shift could lead to greater global financial stability and more equitable distribution of economic power, reducing the concentration of risk in a few large institutions. Despite this ambitious vision, Vigna and Casey maintain a realistic perspective, acknowledging that the path to a fully decentralized future will be arduous and fraught with challenges. They recognize that the journey will involve regulatory obstacles, continuous negotiations with governments to establish frameworks that protect consumers, and prevent illicit activities without stifling innovation. Technological hurdles. Solving issues of scalability, interoperability between different blockchains, and improving user-friendliness for mass adoption. Ethical dilemmas. Grappling with the potential for misuse, ensuring equitable access, and addressing environmental concerns like energy consumption. Resistance from entrenched powers. Expecting fierce opposition from institutions and industries that benefit from the existing centralized status quo. Ultimately, the future is decentralized concludes not with a declaration of victory, but with a powerful assertion of inevitability. The authors believe that the fundamental ideas and technological capabilities unleashed by Bitcoin are too potent and too aligned with the needs of the digital age to be suppressed. They suggest that the long-term impact of cryptocurrencies and blockchain will be less about completely replacing every existing system and more about providing viable, superior alternatives that compel traditional institutions to adapt, innovate, and become more transparent, efficient, and accountable themselves. The chapter serves as both a culmination and a call to action. Vigna and Casey challenge readers to actively engage with this unfolding transformation, to understand its multifaceted implications, and to participate in shaping how these powerful new technologies are developed and deployed to best serve humanity's collective interests. The age of cryptocurrency, they powerfully conclude, is not a fleeting trend, but an ongoing evolution, a journey towards a more open, equitable, and distributed world, and its ultimate impact will be nothing short of global transformation.
And with that profound vision, we conclude our expansive journey through The Age of Cryptocurrency, How Bitcoin and Digital Money Are Challenging the Global Economic Order, by Paul Vigna and Michael J. Casey. This book is a monumental work, offering not just a historical account, but a prescient analysis of a revolution that continues to unfold with breathtaking speed. We've explored how a mysterious digital currency emerged from financial crisis, battled its early demons, unleashed the transformative power of the blockchain, navigated the turbulent waters of investment and regulation, and sparked a true remittance revolution, all while fundamentally altering geopolitical dynamics. It's clear that Vigna and Casey captured the very essence of a paradigm shift that continues to redefine money, trust, and power in the 21st century. Their insights into decentralization, the promise of the blockchain beyond Bitcoin, and the ongoing tension between innovation and regulation remain incredibly relevant, serving as a vital guide for anyone seeking to comprehend the future of finance and technology. If this deep dive has sparked your curiosity, illuminated new perspectives, or simply entertained you, please demonstrate your appreciation by giving this video a hearty like. More importantly, share this episode with your friends, colleagues, and anyone you believe needs to understand the intricate forces shaping our digital future. And of course, for more in-depth explorations of the books that truly matter, ensure you subscribe to the BookMint channel. Your support is invaluable in helping us continue to bring these essential summaries to you. Thank you for joining us on BookMint. Until our next literary adventure, keep questioning, keep learning, and keep building the future.